Good morning, and thank you for joining us today for the Federal Home Loan Bank of San Francisco's Affordable Housing Program General Fund Application Webinar for Rental Projects. We'll be going over the 2024 AHP General Fund application today. My name is Robert, and I'll be one of your presenters this morning. My colleagues Samantha and Brandon will also be presenting. This is our schedule for this morning. During this webinar, we will provide an overview of the bank and the Affordable Housing Program's General Fund. We'll then go over the changes for this upcoming round. We'll give you some insights into how we score applications and how we review the financials for need for subsidy and feasibility. And we will end with a Q&A session. During the Q&A, you will be able to submit written questions to us at any point during the webinar in the Q&A dialog box, and they will be answered during the session. Please do not use the chat function in Zoom for this. Included in yesterday's email to all webinar registrants were several helpful documents that we will reference throughout today's presentation. You should have a copy of the presentation, the application, the rental workbook, and scoring results from the last competition containing information pertinent to this year's round. Before we begin reviewing the application, I would like to talk a little bit about the bank and the Affordable Housing Program, or AHP General Fund. For those of you who aren't familiar with the Federal Home Loan Bank of San Francisco, we are a government-sponsored enterprise and a cooperative made up of member financial institutions that include commercial banks, credit unions, industrial loan companies, savings institutions, insurance companies, and community development financial institutions chartered in Arizona, California, and Nevada. The bank's mission is to enable families and households of all income levels to obtain quality housing and home ownership. First, the bank provides low-cost funding and other services that help member financial institutions make home mortgages and provide credit to people, neighborhoods, and communities. And secondly, the bank funds community investment programs that help members create affordable housing and promote community economic development. The Affordable Housing Program is the bank's largest community investment program. Since 1990, the bank has set aside 10% of its annual net income to support the program. The bank has awarded over $1.25 billion in AHP subsidies to produce over 153,000 units of quality, affordable housing targeted to low and moderate income households. AHP grants are awarded through a competitive application process. The bank's member financial institutions working in partnership with community-based housing sponsors or developers submit applications for specific projects and programs. In addition, the bank has specific down payment assistance programs as well as an economic and community development grant program. This year, we are also adding a new targeted fund that is specifically for Nevada projects. That was actually added last year, and so that program will be continuing this year as well. That fund is very similar to the general fund, but is covered in a different webinar. If you would like to know more about the Nevada Targeted Fund, reach out to one of the contacts listed at the end of the webinar. So just to let everyone know, in the 2023 competition, the bank gave away slightly more than $28 million. We received 125 applications and 32 received an award, which makes for an approval rate of 26%. All 32 of the approved awards were for rental projects. Given the bank's strong earnings for the first 9 months of last year, we could see our available AHP funds exceed $50 million. Although this webinar is focused on completing the application, we think it is helpful to give a brief overview of the AHP process. The application must be submitted in partnership between a sponsor and member. There's only one competition per year, and the upcoming 2024 application deadline is Tuesday, March 5th at 5 p.m. Pacific Standard Time. Be aware that there is also a critical earlier deadline. Applications must request a workspace in our secure portal for each project they would like to submit. The deadline for submitting a workspace request is Tuesday, February 27th at 5 p.m. Pacific Standard Time. If you miss this deadline and do not request a workspace by February 27th, you will not be able to apply. The award announcements will be made in mid to late June. Once an award is approved, both the sponsor and member must attend a compliance webinar prior to requesting the disbursement of the funds. Attendance at a compliance webinar is valid for 2 years. Note that the compliance webinar is different than this application webinar. Once a project has all permanent sources of financing secured, construction is imminent, and the sponsor and member have attended a compliance webinar, the sponsor and member can request disbursement of the AHP funds. Every 6 months until project completion, members and sponsors must complete a project progress report called the semi-annual survey. Awardees must complete construction and draw down and expend the AHP funds within 4 years of award approval. A project must show reasonable progress towards completion to maintain the AHP subsidy. Once construction is complete and the AHP award has been funded, the bank will conduct compliance monitoring called initial monitoring to confirm that the project fulfilled the commitments made in its original application. A request for initial monitoring documentation will be sent 6 to 18 months after the project is complete. Upon project completion, the income retention and compliance period for rental projects will be in place for 15 years, during which the project must continue to meet its original scoring and affordability commitments. Please make sure to refer to our policy updates located under the AHP section in the Resource Center on our website, as they provide important policy guidance for the AHP process. Now we'll go over some basic program information. The AHP is a source of gap financing for rental projects, and the maximum award amount for a project has increased this year from $1 million to $2 million. Because members and sponsors apply together, they are partners throughout the life of the award. The AHP award is a subsidy structured in the form of a forgivable loan secured for 15 years by the member in the form of a promissory note and deed of trust. The AHP can only be used to assist those households at or below 80% AMI, and the program is structured in a way that rental and home ownership projects compete together, meaning that there is no specific set aside for either project type. The AHP can be used to cover acquisition, construction, or rehabilitation costs for rental or owner-occupied projects. AHP awarded projects are required to fulfill scoring commitments. If there are project changes after the award is made that affect scoring, a modification must be requested. A project must demonstrate a financing gap and that it will be financially feasible at all phases. If the project receives AHP funding, it must continue to demonstrate a gap at the time of disbursement and at the time of compliance monitoring. Again, a project has 4 years to utilize the AHP funds and complete construction. The bank will review the project status twice a year and follow up directly with projects that do not demonstrate reasonable progress or the ability to finish in 4 years. Projects awarded AHP funding must comply with fair housing and affirmative marketing requirements. Projects that are already complete, as in those with a certificate of occupancy or notice of completion at the time of the application deadline, are ineligible to apply for AHP. For projects that already have an existing AHP award that need additional funds, you can only resubmit an application to request additional funding if you first cancel the original award. As mentioned before, the maximum subsidy request amount has increased to $2 million this year. The sponsor eligibility threshold has also been revised and is now a minimum of 1 year. We have a few updates about multiple applications for AHP subsidy, and they are as follows. A project may apply for and receive AHP funds from both the bank and another FHL bank as allowed by the other FHL bank's policies, provided that the project shows a need for both AHP awards. If only one award is needed, the project must only accept one award. An incomplete project with an existing AHP award from the bank that seeks a larger AHP award must first withdraw its existing award and then reapply. A completed project with an existing AHP award that is still within the 15-year retention period from either the bank or another FHL bank must also withdraw any existing awards before applying for a new AHP award. Concurrent applications to the Nevada Targeted Fund and General Fund must request the same amount of AHP subsidy in each fund. For donated property, our guidance has been revised to clarify that donation transactions must occur within 5 years of the application deadline or start of construction. Appraisals must be prepared by an appraiser certified in the state where the project is located. And for projects owned via a long-term lease that are seeking credit for donation at a nominal value, annual lease payments must sum to $1,000 or less during the 15-year retention period to receive points. For nonprofit scoring, the category has been increased by 2 points for a total of 9 points. We have a new 2-point scoring category for emerging minority-owned business enterprises and/or women-owned business enterprises. Also, guidance has been clarified for documentation requirements for nonprofit sponsor ownership interest and developer fee, and we will get into those in more when we look at this category. For housing for homeless households, guidance has been revised to clarify that the fifth definition of homeless does not apply to most projects. We will review specific definitions of homeless further into the presentation. The subsidy per unit scoring category has decreased by 2 points for a total of 5 points. Here are a couple things to keep in mind while filling out the application form. The application automatically adjusts based on the characteristics of your project. Progress in filling out the application is tracked at the top of the workbook and in each section. Applications can easily jump between sections through hyperlinks within the document. Through icons next to each data field, the form will also tell applicants what information is required and if each section is completed correctly. Make sure to read the instructions for each section and understand the scoring category requirements. Don't forget to reference and upload backup documentation if required for a scoring category. Too often, points are not awarded because the documentation was not provided. Unfortunately, we cannot contact you during the round to ask for missing documentation. Address all error or warning messages. The application form is intended to help you get the right information in the right data format for us to score your application. Data fields with error messages will not be scored. Make sure the information is consistent. For example, the targeting in the application should match the targeting in the financial worksheets. Inconsistent information may result in a loss of points. Make sure that your application is 100% filled out before you upload your final version. This will be noted by the progress bar at the top of the worksheet. Almost all the questions require an affirmative or negative response, even if the question doesn't apply to your project. Remember that it is best to fill out the application questions sequentially to avoid formula errors. I just wanted to make note that we've created maximum character limits for some text boxes on the application. The text boxes are filled in visual appearance and only expand when you double click on the box. The text boxes should have enough space for the appropriate responses to be seen without having to double click on it. However, if you have more to write, you can upload separate additional documents. The application provides an estimated score to be used as a reference only. However, just to note, the bank will make the final determination in the awarding of points, and the interpretation and implementation of scoring criteria is at the bank's sole discretion. Application documents must be submitted electronically through one secure online portal. To get started, the member and sponsor must complete and submit a request for a project-specific workspace folder on the secure portal for each application by 5 p.m. on Tuesday, February 27th, 2024. If you do not have a workspace, you will not be able to apply. For each application, the member and sponsor can authorize up to 5 employees to submit documents through this secure portal workspace. We will notify the designated member and sponsor representatives via email to complete authentication to get access for each workspace. The portal users will have to click on the link in the email and follow the instructions. Members are strongly encouraged to review all completed application materials and documentation prior to submittal. As you upload your completed application, combine supporting documentation into one PDF file for each folder. While the portal allows you to upload multiple files to one folder, only one file can be accepted into our system. If files are not combined, we will not receive important backup documentation needed to score your project. Keep the application form and financial workbook as Excel files in the appropriate format. Some things to keep in mind when uploading documents. Make sure documents that need signatures have a signature. We do allow for DocuSign signatures as well. Do not rename, move, or delete the folders. This can cause us not to receive your documents, which could jeopardize your project score. Do not restore files from the workspace recycle bin, as this can also cause errors. If you re-upload updated documents to the same folders, it will overwrite the existing one. Do not submit documents without redacting personal identifiable information such as social security numbers, driver's license numbers, or bank account numbers. Do not upload encrypted documents because they cannot be imported into our system. Make sure that everything you upload by Thursday, March 9th is what you intend to submit. You will not be able to upload anything after the deadline. Note that there is no submit button in the portal. Whatever is uploaded in your workspace on the deadline is your final application package. Lastly, make sure that the secure online portal website is not blocked by your IT department, or have them unblock it so you can access the workspace. Make sure that there is only one PDF per folder. Combine multiple files into one, and only one file can be accepted into our system. So if you upload multiple documents, it is likely they will not all be received and you may lose points. Remember that we cannot contact you during scoring, so make sure everything uploaded when submitting your application is correct. So now we will go over our scoring overview. As we go through the application, this is how the total 100 points for the application are allocated for the 13 scoring categories. Most of the categories are straightforward. All categories are self-scorable in the application. It's impossible to get all 100 points since this is an open competitive application with both rental and owner-occupied projects competing side by side. Some questions are only relevant to rental projects, while others are only relevant to owner-occupied projects. This keeps the scoring balanced and levels the playing field for both types of projects. As I go through each of the categories, note that there will be categories where all applicants typically get full points or score well. And then there are other categories where not many projects will get points. It's in these categories that a project can have a scoring advantage in the application process. See the 2023 scoring results in the materials we provided for the average scores of last year's approved projects. Please double check that your submitted documentation is uploaded and clearly shows that your project meets the requirements of the category. If documentation is insufficient, we will not be able to award points. So next, I'll pass it over to Samantha to go over the scoring categories. Feel free to follow along with a copy of the application open in front of you.
Thank you, Robert. So our first scoring category is targeting. Targeting is worth up to 20 points, and it is the largest possible point category for any one category. Rental and owner projects are scored separately. This is an extremely competitive category, meaning most approved applications receive full or near full points. To get the full 20 points in this category, at least 60% of units must be targeted to households earning 50% or less in the area median income, or AMI. When less than 60% of the units are targeted to households at 50% of AMI, then points are awarded on a declining scale. Projects can also include market rate units. However, there is a minimum threshold to be eligible for AHP. At least 20% of the units must be targeted to 50% AMI households. On the application, you will enter the number of income restricted units and their corresponding AMI levels into the yellow shaded cells in the table. The gray cells will be activated and turn yellow once the number of units are entered in the cells. We suggest you enter in the number of non-income restricted units after that. The total non-income and income restricted units must equal the total number of units in the project. Be sure to indicate the number of total managers units as well, regardless of whether that unit is income restricted. Please make sure to enter only whole numbers with no decimal places, or you will get an error. Information in this section must be consistent with the targeting worksheet in the financial workbook. For occupied rental projects, households must be income qualified to meet AHP targeting commitments at one of 2 points in time. Upon initial occupancy, after completion of acquisition or rehab for projects with approved relocation plan, or at application for projects without an approved relocation plan. This means that grandfathering in households who were income qualified at move-in date or prior to the AHP application is not allowed. For households whose income has increased during their tenure of the project and now exceed the unit's original targeting designation, targeting commitments in the AHP application should reflect current household income. For example, the targeting for a unit where the household was income qualified for a 50% AMI unit at move-in in 2015, who is now earning 80% AMI, should be set at 80% AMI, not 50% AMI. In the last competition, the average score for an approved project was 19.94. Thank you. So donated property is the next category. Points will not be awarded if less than 20% of the project units or land associated with the project meets the category criteria. Points can be prorated if not all the units qualify. There are 3 situations that qualify for points. The first is a straight donation. If the site is acquired or to be acquired from an unrelated third party for $1,000 or less, or a long-term land lease is executed for $1,000 or less in total rent payments over the 15 years, then the application is eligible for up to 5 points. If this scenario is relevant to your project, complete the first section titled Donation of Property. Next is acquisition of property from a federal agency. If land is conveyed from a federal agency at a price greater than $1,000, then 1 point will be awarded. If this is the case for your project, complete the middle section. The third way to get points is if land was acquired from an unrelated third party at a significant discount to fair market value. So, for example, If you have a property with a fair market value of $1 million and your purchase price is $200,000 or 20% of the fair market value, you've received 1 point. If the purchase price is $150,000 or 15% of the fair market value, you receive 2 points. If the purchase price is $100,000 or 10% of the fair market value, you'd receive 3 points. If the purchase price is $50,000 or less, or 5% or less of the fair market value, you receive 4 points. If this scenario fits your project, please fill out the third section under donated property called acquisition of property below fair market value. For all these situations, the donation or conveyance must be an arm's length transaction. In other words, the sale or transfer of a property from a nonprofit developer to its affiliate will not be eligible for points, nor would the sale of property owned by a co-general partner to the partnership be eligible for points. Donations cannot come with any financial conditions or strings attached, such as a loan or other payment conditions. Transfer of title from donor to the sponsor does not have to take place prior to the submission of the application to receive credit, but you do need to submit documentation to get points. If the property has not yet been donated, but will be at a future date, the bank will give credit for legally binding, fully executed purchase contracts, lease agreements, and other options, or an exclusive right to negotiate that includes specific purchase or lease costs. Note that a letter of intent to donate the property is not binding and therefore would not be eligible for points. As a reminder, points can be deducted if the transaction does not materialize, and a reduction in points could jeopardize your award. So you want to make sure that the donation is a sure thing when requesting points under this category. For acquisitions at an amount significantly below fair market value, an appraisal must be submitted with the application and must have been completed by an appraiser certified within the state where the project is located. Also, the appraisal valuation date must be within 6 months of the acquisition agreement date. Information on the support documentation should be consistent with the address and APNs included in your application. Make sure there is a clear linkage between the parties in the documentation submitted. Also, make sure that donated or conveyed amount is consistently reflected in the development budget. This is the link between scoring and the financial review. We do confirm that there is no acquisition cost or that there are just the nominal costs in the budget. If you have a project where the land was initially donated by a third party, but you will be required to show a value in the budget for accounting purposes, please contact us offline to see if this will be acceptable. We will need to see that there is no gain on sale from any subsequent transfers after the initial donation. For properties that were donated or conveyed at a nominal or below market value price prior to application, transaction consumption must have occurred within 5 years of the application deadline or start of construction. Consummation, whichever is earlier. Donation or conveyance at a nominal or below market price must ultimately be documented to maintain points. For projects owned via a long-term lease that are seeking credit for donation at a nominal value, annual lease payments must sum to a total of $1,000 or less over the course of the 15-year retention period to receive points. Under the donated or conveyed property section of the application, you must enter the number of units that apply to each situation. If none of the situations apply, you must enter 0. If you think your project qualifies for these points, see our implementation plan for more details. In the last competition, 34% or 11 of the 32 projects approved applications received points in this category. So the next category is nonprofit sponsorship, which is now worth 9 points this year. This is an overview how the 9 points are allocated in this category. In addition to awarding points themselves, we will be evaluating the project sponsor's roles and responsibilities in this project to make sure that the project sponsor is qualified and active in the development of the project based on the information included in the sponsor profile section. First, the bank has discretion in determining whether a nonprofit sponsor meets the category and general sponsor eligibility threshold requirements. The nonprofit status of an organization is a threshold criterion, and you would be eligible for the remaining points if the two statements under the sponsor classification section are true, and you are a qualifying organization. The general sponsor eligibility requirements are: sponsor has been engaged in the ownership, management, or development of affordable housing for a minimum of 1 year. Sponsor has sufficient capacity and staff experience to perform project roles and integral responsibilities. Sponsorship has an ownership interest in the project, including any leasehold, partnership, or controlling interest through the entire 15-year retention period. Sponsor is integrally involved in project responsibilities such as project planning, project development, construction, property management, and securing development financing or other funding commitments. For not-for-profit organizations or government entities, the project sponsor must be the parent organization and not an affiliate organization. Make sure you are indicating the correct entity in your workspace setup request form in the application. Examples of an affiliate organization that do not generally qualify for project sponsorship include the development affiliate of a nonprofit or housing authority, the project LP, a CHOTO affiliated with the parent organization, an LLC affiliated with the parent organization. Please note the type of entities that qualify for points are nonprofit organizations, Native American tribe, an Alaskan Native village, or the government entity for Native Hawaiian homelands, a state housing agency, local housing authority, and a state or political subdivision of a state. If the sponsor meets the criteria, then the next 4 points are allocated based on ownership interest in the project. Also, there is a regulatory requirement that project sponsors must have ownership interest in a project for the entire 15-year period. If an entity is working to develop the project but will exit ownership structure after completion, this entity should not be on the project sponsor. 4 points are awarded if the nonprofit sponsor entity owns greater than 50% of the project, or if a project is owned by a limited partnership. Points are dependent on the nonprofit sponsor general partners or GP's ownership interest. A nonprofit GP with greater than 30% and less than or equal to 50% ownership interest receives 2 points. If the nonprofit GP has less than or equal to 30% ownership interest, then 0 points are awarded. Please be aware that points will not be awarded for commitments that are made contingent on receipt of AHP funding. Only the ownership percentage that is in place as of the AHP application deadline. In the application, you will need to indicate the limited partnership's interest distribution and the interest distribution within the GP. If there are 2 general partners, the nonprofit project sponsor and nonprofit partner, then 4 points are awarded. Please provide the name and type of entity and ownership interest in the table. If there are 2 general partners comprised of the nonprofit sponsor and a for-profit general partner, and they both have 50% voting and ownership interest, then only 2 points will be awarded based on a nonprofit entity only having greater than 30% ownership interest. Note that 4 points are awarded only if the ownership interest is greater than 50%, not equal to. The next points are awarded based on the percentage of total available developer fee received by nonprofit sponsor, including future investor payouts and or cash flow. The bank does not want the nonprofit sponsor stuck with just the deferred fee. If the nonprofit sponsor receives equal to or greater than 25% of the fee, or if by some chance there is no developer fee, then 3 points are awarded. If the nonprofit sponsor receives less than 25% of the total available developer fee, then 0 points are awarded. If a project is in construction at the time of application and there is a limited partnership agreement or other agreement with the project's investors, LPA, in place, the ownership interest and developer fee percentage must already be documented by the LPA or by an agreement that is referenced within the LPA to receive points. Otherwise, at disbursement, we will need to see that LPA or operating agreement or a document reference therein confirms the ownership interest and developer fee split. Make sure to select the correct response here. If you mark that the project has no developer fee and we note a developer fee in the budget, then you may not receive the 2 points. As proof of tax-exempt status, a nonprofit organization must submit the IRS 501c3 letter or a state franchise tax board letter. The bank does not accept bylaws or articles of incorporation as a substitute for showing tax-exempt status. If there is an entity name change, please submit the updated IRS documentation. And if the sponsor is a government or tribal entity, then no documents are required. Please also include an organizational chart of the project's ownership structure with your application. In 2023, 97% or 31 of the 32 approved projects received the full points in this category. So a new subcategory has been introduced to the nonprofit sponsorship category that awards 2 points to emerging minority or women-owned developers. If the project earns at least 5 points in the preceding subcategories, the project may earn points in this subcategory, meaning the sponsor may have some amount of ownership interest and must receive at least 25% of the developer fee in order to receive these points. Emerging minority or women-owned developer points will be awarded to projects that meet both of the following criteria. 1, the project sponsor is a minority and or women-owned developer defined as meeting at least 2 of the 3 following criteria. The sponsor's CEO or executive director is a minority or woman. The sponsor's board of directors is greater than 50% composed of minorities or women. The sponsor's senior management, as defined by the organization, is greater than 50% composed of minorities or women. 2, the project sponsor organization has fewer than 5 years of development experience and or has developed fewer than 5 projects in the past 10 years. The sponsor must certify that they meet this criteria using the AHP Emerging Minority or Women-Owned Developer Form, which is a new attachment for this year that you will see when you download the application package. Please note, this is a new subcategory. We surveyed other emerging developer programs, and while we believe our requirements are aligned with other programs, please let us know if you discover a conflict between this new subcategory and another emerging developer program. So now I'll turn it over to Samantha to continue going through the general fund scoring categories.
Thank you, Brandon. The next category is homeless housing. It is a 6-point category, and points are awarded to projects that create transitional housing or reserve and set aside permanent rental units for homeless individuals or households. Please be aware that projects are not able to score points in both the housing for homeless households and housing for special needs population scoring categories. So you will need to make a choice if you serve both populations. On the application, please describe the homeless program in the text box provided, including a description of the outreach activities and referral agencies used to reach this population. The AHP regulation requires that the bank provide or set forth a homeless definition in the implementation plan, which we will go over on the next slide. At initial monitoring, we are also required to collect documentation confirming that the homeless status of each individual meets our definition. Be especially careful about making commitments here if you have an occupied building with existing tenants who you think qualify as previously homeless. In addition to making sure that they met the definition at move-in, you will also need to provide documentation of their homelessness at move-in, which can be hard to locate for long-term residents. So you'll want to make sure this documentation will be available before you commit. Scoring in this category is slightly different from other unit-based categories where points are simply prorated based on the number of units reserved. For this category, you get an automatic 3 points if a minimum of 20% of units are reserved for homeless households. The remaining 3 points are prorated based on a ratio of the remaining units that are reserved for homeless households. The bank is trying to encourage projects to reserve units for this population. When we say reserved, we mean that units should be held vacant unless occupied by a household meeting that definition. Additionally, to receive points for homeless housing, there is a minimum stay requirement of 6 months. Transitional housing projects are eligible if they require a minimum of 6 months occupancy and meet the transitional housing definition, which means that 1, the intention is for households to stay for at least 6 months, not just that they could technically stay, which is true of some shelters. And 2, if the project is operational, most households in the transitional units actually do stay for at least 6 months or move into permanent housing within that time. Households also do not need to pack up their belongings and vacate the premises during the day. and they need to have access to supportive services, programs, or other efforts that will help them transition out of homelessness. That means that overnight shelters often do not qualify for homeless points because of the minimum stay requirement and the thresholds needed to qualify as true transitional housing. Overnight shelter projects can still apply for AHP funds, but would not receive any points under the homeless housing category. If you are developing transitional housing or a shelter project that includes shared rooms, make sure to enter the number of projected households as the number of units in the project. Also, please note that the units listed as reserved here must be consistent with the number of units indicated on the targeting worksheets. On the targeting worksheet, we will look to see if rents are appropriate for the population. Often, we would expect to see a dedicated rental subsidy. If your project is reserving units for homeless households, and those units are targeted at greater than 30% of the area median income, and there's no dedicated rental assistance for these households, then you also must explain how the project will be feasible for the 15-year AHP compliance period and provide documentation from a homeless service provider that confirms that enough households exist in the target market area that can actually pay the scheduled rents listed for the units reserved for these homeless households. In the 2023 competition, 69% or 22 of 32 approved projects received some number of points here. This slide is the bank's current definition of a homeless individual or household as included in our implementation plan. Make sure that you review this definition carefully if you are requesting points in this category to ensure that all reserved units meet our definition. Note that the fifth definition of homelessness is generally only available for permanent housing developments and not for shelter projects, as it is tied to specific funding sources and does not apply to most projects, as it must be documented with funding guidelines from a government agency that specifically serves this population. Unfortunately, what does not meet the definition are those at risk of homelessness, such as a person living in an overcrowded condition, living in a hotel or motel not paid by charitable funds, or living in the home of another individual due to economic hardship. For all the details, please review this scoring category in the implementation plan. The next category is special needs. Up to 5 points are awarded based on the percentage of units reserved for special needs populations, those that fall into the 5 categories listed here. A minimum of 20% of the units must be reserved to get any points, and points will be prorated if not all units apply. For example, if 50% of the units are reserved for one or a combination of these populations, you get 50% of the points. There is no double counting for this category. As you can see from the application, there are multiple categories possible. You will not receive credit for more than one designation for the same unit. More than one of these designations can apply to the same unit, but you will get an error message if the number of units input into the application exceeds the total number of units in the project. As noted previously, you cannot receive points in both this category and homeless housing. Also, please note that in the financial workbook, the units set aside for special needs households must be indicated on the targeting and financing sources worksheet. To get points, they must match what is indicated on the application. In the last round, approximately 16% or 5 of the 32 approved projects received some number of points in this category. Here, we have our large units category. Similar to homeless and special needs, at least 20% of total units must have 3 or more bedrooms to qualify for points in this category. For example, if 12 of 45 total project units have 3 or more bedrooms, the calculation would be 12 3 or more bedroom units divided by 45 total project restricted and non-restricted units equals 27% or 3 points. Units must be consistent on both the application and targeting worksheet in the financial workbook. Last year, 47% or 15 out of 32 projects received points in this category. Rural housing is a pretty straightforward category. If at least 20% of the units are in a rural area as deemed by a government agency, then you can receive up to 5 points. Points are prorated in this category. In the application, list or describe the agency designating the area as rural after the number of units are typed in. Rural status can be designated by a state or federal government agency, such as the USDA. USDA provides this information on their website under Rural Services. You must submit documentation from the designating entity to support your claim. If this information is not provided, the response is considered incomplete and points will not be awarded. In Arizona, rural area can be designated by a Native American tribal entity. In the last competition, 25% or 8 out of the 32 approved projects received points in this category. The next category is promotion of empowerment. The purpose of this section is to see how your project will financially or economically empower your residents through programs or services. There are 5 services. Each service is worth 5 points. Review the instructions in the notes following each question in the application. Much of the information we want to see in the submitted documentation is outlined there. You get the full 5 points if you meet the scoring guidelines. If you don't meet the guidelines or threshold, then you get 0 points. There will not be any prorated or partial points given in this category. Please be aware that for training and education, the frequency of service must be bi-monthly, every 2 months or equivalent. All services must be of a regular and ongoing nature. Also, all services must be free to all residents except for childcare. Services must be available within 6 months of the project's placed in service date. Documentation is required at initial monitoring to substantiate the provision of services. Points will not be awarded if supporting documentation is not included with the application. If the project has some units reserved for homeless households, make sure you submit documentation for services targeting that population, but also remember documentation for other non-homeless residents. Some type of services should be provided to all residents. If the sponsor is providing the services themselves, then a detailed service plan must be provided. To get credit for a sponsor-provided service, the organization must have in-house capacity to provide the service with staff that has appropriate knowledge and expertise. Use the organization's letterhead, then date and sign the services plan. If the project sponsor hires or contracts with a third-party service provider, then the documentation must include one of the following documents: a memorandum of understanding between the sponsor and the third-party organization, an executed service contract, or a letter of commitment. These documents must list the services and funds which partnering agencies have agreed to provide. Again, it should include the information indicated under the support documentation statement. Service commitment documents must be dated within 6 months of the application deadline. If you have an MOU that was executed beyond the 6 months, but the services detailed in the MOU will still be provided to the project residents, then you can have the partner or service provider submit a current cover letter stating that the MOU is still valid and all indicated services will still be provided. Letters of support are not acceptable documentation for provision of services in the empowerment section because they are not a commitment, but are more like references. For example, this includes letters written by people or organizations that support the project sponsor and its work, but are not formalized commitments outlining the provision of services. Also, you must complete the empowerment budget worksheet, which should show annual projected expenses of the service, and you must indicate how the project will pay for these expenses. If this is not filled out, no points will be awarded. This budget is included in the financial workbook, so please fill out this worksheet instead of submitting a separate PDF budget. In the last competition, all awardees received the full points in this category. Next, Robert will go through the community stability category.
Thank you, Samantha. The community stability category is about determining how your project benefits the community at large and contributes to stabilizing the neighborhood. The category is worth up to 14 points. There are 6 main community stability features with specific elements under each feature that you can select. The specific point allocation for each feature can be found in the scoring guidelines in attachment B of the bank's implementation plan. No partial points will be given, and you must submit required support documentation for each selected element to receive points. Like the rest of the application, even if some of the questions do not apply to the project, You'll have to confirm the question does not apply to the project. In 2023, the average score for the top 20 approved projects was 11.2, and the overall average was 10.97. So now let's look at the features a little more closely, and we'll go over how points are allocated. For revitalizing neighborhoods by optimizing project site use, the maximum 3 points under this feature are: your project must involve development of an infill site or adaptive reuse, demolition of a substandard building, or substantial rehabilitation. The points will be awarded if you select one of these elements and submit the required documentation. Although it's already stated in the application under development of an infill site, a recent aerial photo of the site showing the outline of the entire site must be provided to receive points. Otherwise, we may have trouble determining the boundaries of the site and could be unable to award points. For a site to be considered infill development, it must be at least 50% undeveloped, and at least 50% of its perimeter must adjoin parcels that are already developed with existing urban uses. Documentation requirements for adaptive reuse of non-residential buildings or structures need to be clearly shown. It must clearly show the extent to which the project involves adaptive reuse. To receive points for demolition, the demolition must be undertaken by the sponsor, with the one exception that we can give credit to large-scale transformative projects where a public agency has completed demolition within the previous 5 years. Demolition by the sponsor must show costs in the development budget. For demolition by a public agency, documentation must show that the demolition was to enable the project's development and was completed within 5 years of the application deadline. Documentation can include land conveyance agreements or development agreements that outline the demolition contracts, and other documentation that supports the requirements. A demolition contract is not required, but documentation must clearly show the substandard condition of existing buildings to qualify for demolition points. The intent of the category is to award points to projects that remove blight in the community through demolition of substandard structures, not just any demolition. The photo included in this slide is an aerial view of an infill site that is currently vacant with at least 50% of the site as undeveloped, and the photo clearly shows the project site with an outline. For community revitalization or economic development, this feature is worth 2 points. To receive the 2 points, select one of the boxes and submit the documentation. To qualify, the bank's community revitalization or economic development plan area form must be signed by an appropriate planning official and confirm that the plan meets the required criteria. You must meet the following. As the application deadline, a government entity has formally adopted a plan to revitalize a defined geographic area containing the proposed site. A standard housing element or general plan is ineligible unless it contains a specific revitalization area where the site will be located. The project proposed in the application would contribute to one or more of the plan's stated goals. A government entity has made or is committed to specific investments in non-housing infrastructure, amenities, or services beyond developing the proposed project. The project benefits from incentives such as streamlined entitlement process, additional funding, or relaxed design requirements by being inside the boundaries of the plan. As previously discussed, note that we will no longer be awarding points to opportunity zones in this subcategory as they do not meet the required plan criteria. For proximity to transit and amenities, these are awarded being located near transit and amenities is worth 4 points. For the transit element, a project must be located within a third of a mile radius of the specific transit stop. A half point up to a maximum of 2 points will be awarded for each transit service or line. Like the transit component, to receive points under amenities, a project must be located within a third of a mile radius of the specific amenities that are appropriate and accessible to the project residents. For example, the project may be located next to an elementary school, but if the population is 100% seniors, no points would be awarded for that amenity. A half point up to a maximum of 2 points will be awarded for each of the 8 amenities listed. Note that you will not receive more than 1/2 point for each of the categories as shown here in the slide. If there are 3 parks near your development, you will still receive only 1/2 point. Some important things to keep in mind. To receive points under this feature, the transit service or amenity must be in place at the time of application. Also remember that transit agency route maps are still required documentation for the transit section, even though we no longer need timetables. The application outlines how the distances to transit and amenities should be measured and the required documentation. No points will be awarded without documentation or if your documentation is missing information needed to determine distance or destination. Here is a good example of documentation for the number of transit lines near the project. This example clearly shows where the project site is, the distance radius surrounding the project, 1/3 of a mile, and the distinct transit lines that are within the area. It also shows a clear scale and legend from a third party. It is very important for both the transit and amenities documentation that the third-party scale and legend is included, as we had a number of projects lose points in this area during previous years because the third-party scale was missing. This gives us certainty that the information provided is accurate. Otherwise, we can't tell if the map was just created by the applicant. For sustainable developments, this is worth a maximum of 4 points. Points will be awarded for obtaining one of the indicated certification levels. The first level is worth 1 point, the second level is worth 2 points, and the third level is worth 3 points. The fourth level is worth 4 points for lead or enterprise certified projects with net zero certification. The Nevada Housing Division's Silver State Sustainable Home certifications is also included as an accepted certification and is awarded 1, 2, or 3 points depending on the level of certification. One important point I would like to emphasize is that you should not overcommit here. If the commitment is not met, this would lead to a future project modification involving a loss of points, which could jeopardize the project's award. Also, be aware that new construction projects are not eligible for points related to improvement over an existing HERS rating. Scoring credit for this type of certification is limited to renovations. For home ownership and economic integration, this is worth up to 2 points. 1 point will be given for the creation of home ownership opportunities. Home ownership opportunities are rarely applicable to rental projects unless there is an established home ownership conversion plan, such as a lease to own plan. These are rare, but if this applies to your project, documentation of the plan must be included and there must be an enforceable mechanism in place to ensure that the home ownership opportunity is available. 1 point will also be given for a project being located in a high resource area. The location of a project needs to be in a high or highest resource area where the designation exists. For example, in California, using TCAC's opportunity area maps as shown on the slide, or to an upper income census tract in areas that do not have this type of designation. California projects must provide a printout of the state's opportunity map. Non-California projects must provide a printout of the project census tract from the website of the Federal Financial Institution Examination Council, showing the project's location in an upper income census tract. Do not miss out on points for location in the indicated areas. Even if you are sure your map is in a low income census tract area, go to the FFIEC or your tax credit agency's Opportunity Map website and enter the project address to confirm. All project units, including scattered site projects, must be in a high or highest resource area or upper income census tract to qualify for points. Note that you may choose to utilize the census tracts or census block group resource designation from the high or highest resource maps in effect when the initial site control was obtained up to 7 calendar years prior to the application. If you go this route, make sure to make this intent clear in your evidence of community stability PDF and include site control documentation along with the older maps. For preventing or minimizing household displacement, 1 point will be awarded for no household displacement for a site that is vacant and unoccupied or that the project site is occupied and an acceptable relocation plan is in place. To receive the 1 point for no displacement, you must provide a written explanation of the project's site history and confirm why no displacement is taking place. To receive the 1 point for displacement with relocation, you must submit a relocation plan. A relocation plan is only required for residential displacement. If a project involves relocation, then we expect to also see the relocation expenses in the budget and an acceptable relocation plan, which we will go into detail about in the next slide. The implementation plan provides specific requirements for a relocation plan. Again, this is only required for residential displacement. If your project is required to go through a relocation plan process by one of its other funders, this should be fairly straightforward as you can just submit your relocation plan that has been approved by that funder as noted here. If you do not have a plan approved by federal, state, or local government funders, you can write your own plan, but make sure it meets all the points in this slide, including a budget. This applies to temporary relocation within a building as well as permanent relocation and relocation where households are moved out of the project for a period of time while work is completed. We recognize that all elements are necessary for all types of relocation. So if an element is not appropriate, include a brief explanation why it is not necessary for your project's relocation plan. So that brings us to the end of the community stability category, which clearly offers a variety of avenues for your project to receive points. So now I'll pass it back to Brandon to finish out the rest of the scoring categories.
Thank you, Robert. So in the project readiness category, points are awarded to projects that have some measure of site control. 3.5 points are awarded for full site control where you already own the land or building or you are going to develop. Documentation must be submitted as evidence for the different options listed in the application. A final settlement statement, title insurance policy, executed disposition, and development agreement or title reports. 2 points are awarded for partial site control, where you have an agreement to purchase the land or building. Documentation must be fully executed and valid and is required for all parcels. And it must clearly show that the project sponsor or partners have site control or that there is a link to the sponsor. Please make sure that the addresses and assessor parcel numbers, dates, and signatures are consistent and are included in the documentation, especially if this information is an exhibit. If you receive full points for site control, then you qualify for points under building permit issuance or building permit readiness. The building permit readiness form must be signed by the building department to receive 3.5 points, whether you have permits or a permit ready letter. Only the form needs to be signed, and you do not need to attach the actual permits or ready letter itself. For projects on Native American tribal lands, a proxy letter from the tribal council or entity is acceptable in lieu of the building permit readiness form. Just a note here, a new form must be submitted every time the application is submitted. Also, if you only have partial site control, you will not qualify for points for having a building permit readiness letter. On the application, even if some of the questions do not apply to the project, you will have to indicate the zero number of units apply under the question. In 23, the average score for approved projects in this category was 5.92. So this is a very straightforward category. Points are not prorated. Basically, if your project is in Arizona, California, or Nevada, you will receive 5 points. If the project is located anywhere else, you will receive 0 points. On the application form, the question is automatically answered based on the project address provided. Last year, all 32 projects were awarded in district. So this category is designed to support development located on tribal land or developed by tribal entities. Projects where all units meet one or more of the criteria listed on the slide will be eligible for points. The project owner can be a tribal government, an agency of a tribal government, a tribally designated housing entity for the purposes of the Native American Housing Assistance and Self-Determination Act, or an entity incorporated created in accordance with the tribal law. This is a very easy way to get points in this category. Alternatively, you can get points if tribal funding is included as a source of funding for the proposed project, such as Indian CDBG, Indian CSBG, Indian Health Service Funds, or NAHASDA funding. The amount of tribal funding included in the sources of funds must be an amount equal to or greater than the lesser of 5% of the project's total development cost, or $100,000. While we haven't gotten a project submitted from Hawaii in a while, you could also receive points if the project is in a Hawaiian homelands housing area. Last year, one of the 32 projects received points in this category. So the subsidy per unit category has been reduced by 2 points and is now worth 5 points. In the AHP, there isn't a maximum subsidy per unit, but keep in mind that each project may request up to a maximum of $2 million, and the member limit is $15 million. But since this is a competition, you get more points the less subsidy per unit you request. Basically, the score is calculated by taking the amount of subsidy requested divided by the number or income restricted units. Those that are restricted to households earning at or below 80% of AMI. The scoring for rental and owner projects is different. For rental projects, the range is between $15,000 and $40,000 per unit, with a full 5 points for $15,000 per unit and 0 points for $40,000 per unit. The category is scored when you enter the amount of subsidy requested in the beginning of the application and complete the targeting scoring selection section. We often get the question, how much should I request? And we encourage applicants to request what the project truly needs to fill the gap. However, you may need to balance what your project needs with what score you will make, what will make your project more competitive. In 2023, 29 out of 32 projects received the full points in this category. Okay, now that concludes the review of all the scoring categories. So at the bottom of the application e-form is a scoring summary that will generate as you fill out the application. This tool will help you see your estimated score before you submit the application and should help make sure this process is as accurate as possible. You can also use this tool to evaluate how competitive your application will be when comparing your project's estimated score with the scores of the previous year. There is no way to predict what range of scores will be in any given year. But if you aren't even close, you might not want to spend your time on submitting an application. Now, we're going to take a 5-minute break and we will finish up the webinar after this break. Welcome back, everyone. In this next part of the webinar, we will provide information on how we evaluate a project's need for subsidy and feasibility and go over the financial worksheets. Not only do applications have to score well, but they also must meet the Federal Home Loan Bank standards to demonstrate that the amount of subsidy requested is truly needed in that project and is also financially feasible. So, in determining need for subsidy, we look at the financials to make sure that the project demonstrates a financing gap. We also look at the project's financing structure and development costs. And we also look to see that the project's sources of funding, including the AHP, equal their projected development costs. And we additionally look to see that AHP is filling a project's financing needs that's not covered by other funding sources, and that the project is only asking for enough AHP to truly fill the gap. Please note that we will continue the same treatment as previous years regarding non-arm's length transactions. Net gain on a sale in a non-arm's length transactions that is not reinvested in the project will be considered excess funds and will be factored into our evaluation of the project's need for subsidy. For financial feasibility, we make sure that there is no remaining financing gaps in the AHP factored in. And we review the 15-year operating pro forma to make sure that the project is financially feasible through a 15-year compliance period, meaning that cash flow is greater than zero and that there is a sustainable source of subsidy for projected deficits. For financial benchmarks, to help us evaluate need for subsidy and feasibility, we use a set of financial benchmarks that projects must meet. These benchmarks are updated often to try and reflect industry standards. If your project deviates from a benchmark, an explanation must be provided. And also, please be aware of the note at the bottom of the slide. A project must demonstrate need for subsidy and financial feasibility at application, disbursement, and compliance monitoring. If your project has cost savings or receives additional unexpected equity, this could result in required repayment of the subsidy. There are several factors at play here, so please contact us if you think you may have a need for subsidy issue after you are awarded funds. So for rental projects, these are some key points we keep in mind when we look at applications to evaluate the need for the AHP subsidy and financial feasibility of the project. If there are more sources and uses, then some of the AHP funds requested are not needed, and it becomes a need for subsidy issue. If there are more uses and sources, then the project is still short funding and is not considered feasible. To be financially feasible, the project's operating pro forma must show that it has sufficient projected cash flow to cover its projected annual operating expenses and debt service. If there is an operating shortfall projected in the pro forma, there should be operating subsidies or operating reserves to ensure that the project is operationally feasible. Please provide evidence of those subsidies if they are secured already. We also check that the financials match the story being told in the application's narrative. These expenses indicated in the development budget must be consistent with the project's description and scoring sections. For example, under the community stability scoring section, if the project claims scoring points for mitigating the displacement of previous residents during construction with the relocation plan and compensation, then we expect to see relocation costs listed in the development budget. Lastly, we check if the project has any benchmark deviations, which I'll go into more detail in the next slide. If there are benchmark deviations, we need an explanation for why the project's costs are outside what we normally see. All deviations will be calculated automatically in the workbook and be highlighted in yellow, except for interest rates, which need to be compared to the rates in the reference guide. Benchmark deviation explanations must be quantifiable in relation to the amount that exceeds the benchmark. For example, if your project exceeds the operating cost per unit benchmark by $50,000, you will explain that $40,000 of payroll is for 24-hour desk clerks and $20,000 of extraordinary maintenance and repair costs are not typical requirements, but are needed to serve the project's homeless population. Once that $60,000 is removed, the project is within the benchmark. If the project has conventional debt and the debt service coverage ratio benchmark of 1.45 is exceeded in year one, it indicates that the project might be able to take on more debt and that the project may not demonstrate a need for an entire AHP amount requested. In that case, it may be ineligible unless there is a legitimate reason the project cannot take on more debt. Note that we have a line in the pro forma that is for required services. As you know, we are required to show services below the line. So it is not an operating expense. However, there is a test DSCR so that it is easier to see how other funders are looking at the project's debt service. Our benchmark still ties to operating expenses without services, but we hope that the test debt service coverage ratio will make it easier to explain some of these deviations. For the construction cost per square foot, site work can be used as a part of your benchmark deviation explanation. Environmental remediation and hard cost contingencies are still not included at the cost per square foot calculation and should not be used for explanation. Our financial worksheets are intended to accommodate the wide variety of projects that apply for AHP. So here are some key points to keep in mind for certain types of projects that don't fit neatly into the AHP framework. For transitional housing or shelter projects, on the targeting worksheet, make sure to list each household as a unit rather than the number of rooms or beds. Make sure to be conservative here for projects with a fluctuating number of households, as many scoring areas are tied to the number of units, and you want to avoid being in the position of losing points and potentially the award in the future if your occupancy turns out to be lower than expected. Often the feasibility of these projects is based on donations, capital campaign, fundraising, or another business revenue. We want these types of projects to demonstrate that they have a reliable source of raising the funds they need for development and have a reliable source of income coverage to cover operational expenses. We consider 3 years to be reliable, so please upload 3 years of audited financial statements to the evidence of committed financing folders if this applies to your project. For mixed-use projects, under AHP regulations, residential rents cannot support the commercial portion of the property, but commercial rents can cover residential expenses. Note that even though commercial income can cover residential expenses, the residential portion of the project should not be dependent on commercial income for feasibility. If you have a mixed-use project and the commercial space will be revenue generating, fill out the 15-year commercial operating pro forma in the workbook. Make sure to answer these 2 questions at the top of the worksheet. On the development budget, there is also a line item at the bottom of the worksheet that indicates the development cost for the commercial space. Make sure that the line is filled out if your project is not on a triple net lease and commercial and residential expenses are together. So a couple of things to mention on the financial workbook. Please use the version that comes with the application packet you download. You should see version 5.4 in the top of the right corner of each worksheet. Essential instructions and notes on completing the financials are included in the workbook on the first tab. We strongly recommend reading the instructions on the first tab prior to completing the workbook. Worksheets should be filled out sequentially, starting on the second tab of the workbook with the targeting worksheet. The worksheets are all connected, and figures and amounts automatically pulled onto other sections of the workbook. We have password protected the shaded cells so that they can't be altered. You can only enter data into the unshaded cells. Again, please review the worksheets so that they are accurate and consistent before submitting them. Please make sure that the sources in the workbook match the source documentation provided. Note that we rarely allow changes to the workbook after it has been submitted. So now, Samantha will review the actual rental worksheets for you.
Thank you, Brandon. To start on the workbook instructions and notes worksheet, we highly recommend that you review this worksheet while you complete your workbook. It contains a lot of helpful instructions and policy guidelines. Next, we will look at the targeting worksheet. Please input the AMI levels in this worksheet to calculate the target income for each unit type. Make sure appropriate AMI targets are set for the population being served. The worksheet, please see the bottom, calculates the rental income for your project and auto-populates the 15-year operating pro forma. At the lower left-hand corner, you will note that 20% of the units must be targeted to 50% AMI or below. This is a program eligibility requirement. This is also where you would note non-income restricted units and manager units. Please be aware that there's a field where you can include non-income restricted special needs units, such as seniors, if appropriate. There's also a similar field for non-income restricted large family units. Next, we will go through the steps. 1. Enter the annual 50% very low AMI adjusted for family size based on the HUD income limit guidelines. If HUD doesn't release the 2024 income limits by the deadline, use the 2023 limits. 2. Upload a copy of the HUD income limits page showing the appropriate income limit data for this project. If applicable, indicate which units are reserved for homeless or special needs populations. The number of units reserved must be consistent with the homeless or special needs application scoring categories. Please input whichever category the project is seeking points under, either homeless or special needs, but not both, due to the scoring guidelines which prevent double dipping in these categories. The AHP application comparison at the end of the workbook will compare this rent roll to the selections made in the application e-form. Again, for transitional or shelter housing, enter the number of projected households as the number of units. Transitional housing units must meet the refined definition discussed earlier in this webinar. Do not input operating subsidies as rental subsidies. There's a specific area where you would input the operating subsidy in the 15-year operating pro forma. AHP guidelines require that the rent paid by each household, exclusive of utilities, not exceed 30% of the targeted income for the unit. Please indicate the total rent received and the amount of rental subsidy, if applicable. The farthest column to the right shows if a unit passes or fails this 30% rent test. Next, we will look at the sources and uses worksheet. Please provide the project's total residential square footage, including hallways, common areas, and structured parking if these costs are included in the new construction or rehab costs. Only commercial areas of the building and commercial structured parking should be excluded from the square footage. Provide tax credit sales price if applicable. If the project will have tax credits, provide either the actual investor letter to substantiate the pricing or other third-party justification for the targeted pricing. Indicate construction type, either new construction or rehab. Also, please indicate the building type, apartments, condos, single-family homes, or townhomes. Please input the project development costs in the uses of funds column. Certain non-cash costs are allowed in the uses of funds budget to align with LIHTC treatment, including donated land value, accrued soft loan interest, and fee waivers. Documentation of purchase price acquisition costs must be provided and consistent with readiness and donation documentation. We are requesting this documentation upfront. We are looking for final settlement statement or HUD-1's executed purchase or purchase option agreements. If in the community stability scoring section you claim demolition, then we would expect to see expenses associated with this line item here, unless your project is a special case where a public entity has undertaken the demolition within the past 5 years per the scoring guidelines discussed earlier in this webinar. If the property owner, lessee, or sponsor acquires the project property from a party affiliated in any way with the project owner, lessee, sponsor, or any other persons or entities involved in the project, in a non-arm's length transaction, the bank will consider such acquisition to be a related party transaction. When evaluating related party transactions, the bank may consider any net cash gain from the transaction as excess sources of funds, unless the gain is 1. Contributed to the project as owner equity, 2. Provided to the project as carryback financing, or 3. Used to retire existing debt on the property. For rehabilitation of existing affordable housing projects not involving the transfer of property, any acquisition costs reflected in the sources and uses worksheet will not be included in the total development costs for the purpose of determining determining the developer fee percentage. Capitalized reserves such as operating, replacement, transitional, social services cannot be paid for by AHP subsidy or by conventional financing. If capitalized partnership management, asset management, and/or investor service fee reserves are included in the budget, provide an explanation and third-party documentation justifying why the capitalized fees are required. Excessive and/or unnecessary reserves may indicate that the project does not demonstrate a need for the AHP subsidy. The bank, at its discretion, will determine whether the reserves are acceptable and appear necessary for project feasibility. Sources of funds. At the top of the worksheet, there are labeled and unlabeled columns for sources of funds. Please indicate the name of the funding source. There are a limited number of columns available, and you cannot add other columns. The workaround in case you need more columns is to consolidate similar sources of funds with a breakdown on an attached document. For example, if you have a number of foundation grants, label one column as foundation grants, and on a separate document, provide a list of foundations and how much each foundation is providing. In each source of funds column, enter the dollar amount on the appropriate line of the costs that each source will cover. Please be sure to indicate all financing details: hard, soft, rates, etc. Hard debt is defined as contractually obligated debt requiring repayment from project operating cash flow, excluding residual receipt loans. The spreadsheet fully amortizes all debt and must be altered in the last column to properly reflect simple interest or interest-only payments. The worksheet automatically calculates debt service payments. Debt service payments are also auto-populated in the 15-year operating pro forma. To ensure consistent and reasonable rate assumptions, interest rates and spreads should be set in accordance with the interest rate assumptions guidelines included in the reference guide. If your loan is already committed, use the interest rate set by the lender and provide backup documentation. For required debt fees, like California's AHP or other state programs in which there is a mandatory annual payment, you can now either enter it here as debt service if the project has other hard debt, or as an expense line item in the operating pro forma if the project doesn't have any other debt service. Documentation of approved sources of financing must be provided. Make sure the sources of financing figures reflected on the worksheet match the figures reflected in the submitted committed financing documentation. Discrepancies are a common occurrence and can result in a reduction in the amount of AHP requested. Note the total committed funds field. Please indicate whether the funds have been approved or not. Remember that the project must demonstrate a need for the entire amount of AHP funds requested. Next, we will look at the sources of funds summary worksheet. This worksheet collects required Federal Housing Finance Agency data. Please indicate which sources are applicable to the project. This is only relevant to permanent financing. Do not include construction and bridge financing. Include HUD, USDA, and VA financing under other federal housing programs. If a source does not fall clearly within the listed categories, please select Other. Next, we will look at the 15-year operating pro forma worksheet. A project must be financially feasible for 15 years. Input income and expense assumptions. All costs except for the management fee, replacement reserves, mandatory debt fee payments, and debt service trend upward. All unshaded cells may be edited. Indicate whether the project is receiving project-based rental subsidy in the top right-hand corner. If the project is receiving rental subsidy, indicate whether it has been approved. If approved, include backup documentation in the evidence of rental subsidy folder. As mentioned before, there's a separate line item expense for any mandatory debt fee payments, such as the 0.42% for California's MHP, AHSC, or BHHP programs. Additional lines are included for other expenses. Please provide details for these other expenses. Please do not use the words miscellaneous or etc. in your explanation. Indicate residual receipt payments on the appropriate lines provided. This is where you would include any partnership management fees or deferred fees paid from cash flow. Make sure that the amount input in the pro forma matches the figure entered on the sources and uses worksheet. Social service expenses are still only allowed below the line and not as an operating expense. However, we have a specific line for them. If you have required social service expenses, please include those in the resident services line. The project must have sufficient income to cover expenses. If not, it must have operating subsidy or a reserve to draw upon. Lastly, make sure to adjust debt service if loan payments change during the 15-year retention period. Next, we will look at the 15-year commercial operating pro forma. If your project includes revenue-generating commercial space, you should fill out this worksheet. This worksheet allows us to assess whether the commercial space is financially feasible on its own. If your project has permanent debt and the perm loan has already been underwritten, indicate whether the lender included commercial income in their underwriting by answering the question at the top of the worksheet. Let us know what kind of commercial lease arrangement there is by selecting yes or no next to the triple net lease question at the top of the worksheet. If the commercial space is operating under a triple net lease, the commercial expenses will only be reflected in the commercial pro forma. If the commercial space is not a triple net lease arrangement, the commercial operating expenses entered in this pro forma will be reflected in the 15-year operating pro forma. Enter all commercial income and the vacancy rate. Total effective commercial gross income will automatically populate in the residential 15-year operating pro forma based on what you include in this worksheet. Please enter all commercial expenses in the lines provided. If hard debt was used to pay for commercial development costs, include the amount of debt service that the commercial portion of the building will carry. Next, we will look at the workbook comments worksheet. We have added this worksheet to allow notes within the workbook related to the project's budgets instead of applicants using the supplementary application materials documentations folder to submit relevant explanations. Next, we will look at the promotion of empowerment budget. This worksheet ties to the scoring of promotion of empowerment. No empowerment points will be awarded if this worksheet is not completed. Please include sources of revenue that will be used to pay for resident services. Include all expenses related to those services. Revenue minus expenses should equal 0. Next, we will look at the benchmarks worksheet. The base information for the benchmarks worksheet will be auto-populated for you, except that you will need to manually compare your project's permanent debt interest rate with the benchmark for interest rate assumptions found in the reference guide. Please provide detailed explanations of and supporting documentation for all benchmark deviations, for example, requirements of other funding sources. Deviation explanations must be quantifiable in relation to the amount the benchmark is exceeded. For example, if your project exceeds the construction cost per square foot benchmark, you might provide a letter from your contractor or architect which explains that the overage consists of $5 per square foot related to special soils work based on the project site, and that $8 of the overage is attributable to prevailing wage premiums on labor costs. If it were not for the $13 per square foot in extraordinary costs, the project would otherwise be within the benchmark. As noted earlier, the construction cost per square foot calculation includes site work. However, environmental remediation and hard cost contingency are not included. Remember that this means that you cannot use your environmental remediation or hard cost contingency as part of your explanation for the deviation. For this benchmark, the bank may use its own portfolio and other construction cost data, in addition to RS means estimates in determining reasonable costs. Exceptions to the developer fee benchmark will be reviewed on a case-by-case basis. This benchmark is 15% of total residential development costs, without developer fee and capitalized reserves included in this total cost calculation. Projects that exceed the 15% limit will have to provide reasonable explanations and support documentation for any deviation to the developer fee benchmark, like any other benchmark deviation. Note that for us to consider a developer fee benchmark deviation acceptable, there must be an equity contribution back to the project that offsets the overage. We cannot accept deferred developer fee or a sponsor loan as a contribution, which is different than other funders. If the developer fee increases to be above the benchmark at disbursement or initial monitoring, repayment of the overage or a reduction in the AHP subsidy may be required. The management fee benchmarks are calculated differently depending on the project's location. This calculation will happen automatically. The operating cost per unit per year benchmark limit is also variable based on location. In the San Francisco Bay Area, SF Bay Area, and Los Angeles Metro Area, LA Metro, the limit is between $5,000 and $10,000 per unit per year. SF Bay Area includes the following 9 counties: San Francisco, Solano, Alameda, Napa, Sonoma, Marin, Contra Costa, San Mateo, and Santa Clara. LA Metro includes the following 5 counties: Los Angeles, Ventura, Orange, Riverside, and San Bernardino. All other locations in California, Nevada, and Arizona are between $4,000 and $8,000. Partnership management and asset management fees should be shown as residual receipts unless otherwise documented. Next, we will look at the targeting self-score worksheet. No additional points are given for units targeted below 50% AMI. To score the project's targeting, AMI targets above 50% must be entered. Next, we will look at the AHP application comparison. This worksheet is intended to help you maintain consistency between data in the application and data in the financial workbooks. When you have finished filling out both documents, click the Run Comparison Now button to identify any inconsistencies. If any errors are noted, please fix them and run the comparison again to make sure the issue is resolved. That concludes the need for subsidy and project feasibility review segment of the presentation. Accessing the application. The application package is on our website. The form to register for the secure portal access is also on our website. You can register for an application workspace on the secure portal right now in anticipation of applying. If you have additional questions beyond what is covered here or answered during the Q&A session, please contact one of us and we will be happy to help get your questions answered. Note that there are 2 sets of contacts, one for setting up your secure portal workspace and 4 contacts for questions about the AHP application scoring and feasibility. Now we will go to the Q&A session.